And we welcome you in to our webinar right here on REI USA. My name's Dave Cole. I'm your host, and will also act as moderator for this presentation. We were talking just a moment ago about everything coming up with REI USA, so be sure to check the website and the calendar. There's live webinars and events all throughout the week. And of course, all the videos and the courses and the training and all the great online resources. So for this presentation, I'm actually really excited about this. And I know people hear insurance and it's not that exciting of a topic. And no, we're not going to sell you a term life plan. And that's not why we're here. But when you're thinking about real estate investing, people don't think about insurance, and they should. So one of the things with Neill is that he is with Lowry Insurance, which is one of our great REI USA sponsors, and they've been a great supporter of our organization and helpful to our members. Lowry is an independent insurance agency. They're out of Charlotte, North Carolina. Started in 1994, so they've gone through a lot. They offer home, auto, and business policies, as well as life and health insurance from a variety of leading characters. And right there, that they offer home insurance and business insurance. And that, to me, is lesson number one for those of you that are investing. And we're going to focus on flipping tonight, but it could be real estate investing in apartments, in multifamily, and single family, whatever your investments are. Note the difference that they do home and they do business insurance, because, okay, you own a home. There are things that obviously need to be insured, but chances are you, as a flipper or even as a real estate investor in general, you probably have an LLC, maybe an umbrella of LLCs. And so a business has different insurance needs than does for the homeowners, or a home insurance policy. So that's part of it. Another thing I want to point out, and you're here to watch Neill and not listen to me, but I happen to run into an investor, and this was, well, back in the days of in-person meetings, so now a couple of years ago, that was part of an apartment syndication. And it was something like a 52 unit, somewhere around 50 unit big apartment building. Unfortunately, that building that he owned part of had a fire that pretty much destroyed 2 units, and evidently got into the ventilation or some other problem that forced them to have to just shut down the building. I mean, they had to move tenants out, and it was obviously a big disaster, and multi-million dollar property. What happened was that they came to find out that the insurance that they had did not cover everything that happened as a result of that fire. And so here they thought they were going to get, I don't remember the exact figure, something like $8 million for the insurance settlement, wound up getting like half of that, and didn't have enough money to redo the building, and basically lost, the investors combined to lose millions of dollars. So this person that I knew was involved in that, and in order to get other investors to want to partner and work with him in the future, put together a marketing presentation showing how he learned from that. And now he makes sure they've got the insurance coverage that they need, and make sure he's got, attorneys looking after attorneys, and every, dotting every I, crossing every T, and how much he learned. And he would document this to show that you should work with him because he's learned from all these mistakes, and he makes sure. But it was because they were not insured enough. Some of you out there may have, I guess we'll use the term horror stories. If you haven't, you're very lucky. So that's one of the things that we want to approach tonight with this webinar. Is it's not only for flipping, it's the need for insurance and knowing what's covered, what needs to be covered. Even properties are different. So anyway, I will let Neill McNair from Lowry Insurance do the presentation. If you do have questions, we will take those at the end, and you can type them in the chat box, either send them to the group or to myself, and we'll address as many questions as we can at the end. So Neill, we welcome you on behalf of REI USA, and we're anxious to hear your presentation.
Well, I appreciate it, Dave, and thank you for the introduction. And I think it sounds like maybe I should get you to do some of our claims examples and some of those things, because it sounds like you've got some good ones. So we'll just jump right into the presentation. As Dave mentioned, my name's Neill McNair, and I'm with Lowry Insurance. And a little bit about myself: I've worked in the insurance industry since 2012. It's not something that when I was growing up as a kid, like, oh, hey, I want to get in the insurance business. It is usually the last thing that people want to talk about. But over the years, I've found that I really do get enjoyment about helping educate people and helping them to protect their real estate investments. And so today we're going to discuss specifically creating the perfect flip. So thank you everyone for joining me. I appreciate the opportunity, and I hope that everyone learns something new after the presentation. I promise I'll do my best not to bore everyone too much. So who has ever found themselves in a situation that you never thought you would be in, and you wonder how you got there in the first place? I know that's happened to me too many times to count. And I'm sure that the captain of this sailboat here, for those of you who have the video screen, it's a sailboat sitting on top of some rocks, completely beached. I'm sure he's wondering the same thing about how he got in that position. Now, I have no clue how to help this guy, but what I can do is help educate you on how to protect your investments. Talking to my clients early on in my career, I learned that most people view insurance as a commodity and a requirement, and that the only reason you're purchasing that insurance on a flip is because the lender who's providing the financing won't approve that until you've met A, B, C, and D that they require you to carry. And to be completely honest with you, I had those exact same thoughts before I started my career in the world of insurance, but it did not take me long to realize that the total cost of insurance is something that can drastically change whether or not you're properly insured. You could save a few hundred, maybe a few $1,000s on the front end by going with a cheaper option. It satisfies your requirements. But in that worst case scenario, if you're that captain of this boat stuck on the shore, if you don't have the proper language, those costs you incur out of pocket that is what you should think of as your total cost of insurance. And that's a drastic difference than a couple $100s or maybe a few $1,000s on the front end when you look at those total costs. So what we're going to learn today, and is my screen kind of blocking the slide a little bit, Dave? Can you see my video screen?
Yes, I can. I've got the "What will you learn" sign and slide, and the lowest line is the "Why full-blown general liability coverage is necessary."
Perfect. So what I hope that you all learn today is we're going to cover 3 key topics that will affect you in a home flip. And the first is going to be a standard property policy versus a builder's risk policy, and which is better for your flip, why you need to have proper risk transfer controls in place, and why full-blown general liability coverage is necessary. And before we jump into those topics, there's 2 main pieces of coverage when you're talking about the exposures on flipping a property. The first one is really easy to understand. It's your physical property, the real property. So we're talking the actual home and those improvements that you put into the home. Those damages are the easy ones to think of. You're talking fire, wind damage, hail, smoke, lightning, vandalism, theft. That's the easy part to understand. But the second piece, which isn't always as easy to understand, is the liability that you take on as the owner of that property and the project manager of the flip. And a common misconception is that both of these coverages are included on the same policy. While there are packages out there that will include both your property and some liability coverage, it's usually not maximizing the dollars that you're spending on insurance, and that the proper language isn't built in there to respond when you need it most. And one thing to understand about an insurance policy is that it is a contract between you and the insurance company. And so it's a written contract, and the language of that contract is extremely important in how it's going to respond to damage or a loss that you have. Now, if you try to read every word of these policies, can be 80 plus pages. If you try to read every word, I can guarantee you your head's going to start spinning. It's written by attorneys. I think people dislike them just as much as they dislike us insurance agents. But it's also, you can keep it next to your bedside table. And if you're trying to fall asleep, read a couple pages and it'll put you right to sleep. But that language is very important to have an understanding of when you need your insurance to respond. And there's talking about a standard property policy, there's three key provisions, exclusions that are included in some of that language that you need to be aware of with a flip. The first is going to be a vacancy provision. And what a vacancy provision does is it restricts coverage on that property once that property has been deemed vacant for a specified amount of time. Now, typically that's going to be 60 days, meaning that policy was unoccupied, uninhabited for at least 60 days, which in a flip, I'd say 99.9% of the time, no one's living there while you're renovating that property. And if that provision kicks in, you could be looking at no coverage at all for a total loss, or they could reduce your reimbursements by up to 15%. So you never want to have a vacancy provision anytime you're doing a flip. Another key exclusion that we see on a handful of standard property policies is a theft and vandalism exclusion. Now, you can find a property form that will have a vacancy form included on there, meaning that there's no vacancy provision. But a lot of the times we see those policies, there's no theft or vandalism coverage. And with a flip, theft and vandalism are the two most likely causes of a loss. And I'll tell you, they account for about 70% of the claims that we see with our home flippers. And the last piece would be that there's, on a standard property form, you're never going to have any soft cost coverage. And the soft cost coverage is going to reimburse you for expenses that were incurred due to a delay in the construction project. And those could be things like additional interest, real estate taxes, legal fees, inspection fees, developer fees. So any property form is not going to have that soft cost coverage included, which is why we always recommend purchasing a builder's risk policy for any type of flip. And the name says it itself. It's a builder's risk. It's a policy that's designed specifically for a home renovation or a ground up new construction. And they can be written on a blanket or a single shot basis. And they'll include enhancements tailored to a renovation, such as materials in transit or materials sitting on site that have yet to be installed. And when I say blanket versus a single shot, so the single shot is going to be one policy that covers one specific project. Now, the blanket option, which is a really cool option that I like to recommend for those who are doing multiple projects, we typically need to see at least 5 or more within a 12-month period. But when you're doing multiple projects, the blanket option is a single policy that's going to cover all of your renovation projects during that policy term. And this makes it easier for you because you're not having to keep track of effective and expiration dates of each individual project. It's one policy that you have to focus on. And it also gives you the advantage of, I'm not sure where everyone is located, but if the markets, from most people I've talked to, the real estate market is insane across the country, where these properties are coming up, a good deal comes up, and it's basically under contract with less than 24 hours. And so having that blanket option, you've already got your insurance in place, you're ready to pull the trigger and act fast. And lastly, the builder's risk form is not going to include that vacancy provision that I mentioned on the previous slide. It's going to cover your project from the date of the acquisition into the date of sale. And this can also save you money when going back to that total cost, where if that property sits on the market longer than expected, sometimes you have to go out and purchase a separate vacant policy. Well, the builder's risk is going to cover that until the date of the sale. So why do you need proper risk transfer? And what is risk transfer? Basically, the risk transfer is when you are transferring the risk and liability between you as the project manager and your subcontractors. And there's two key components to risk transfer. The first is using subcontractor agreements with all of your subs and collecting certificates of insurance from those subcontractors. So what is the subcontractor agreement? Basically, what this does is it's going to ensure that your subcontractors are carrying the proper insurance and that they understand the specific requirements of their job. It's going to lay out what work needs to be performed and the timeline that that work needs to be performed in. And what that's going to do is help build trust between you and the subcontractors. In the event of a loss, there's going to be no room for misunderstanding who was at fault. So in connection with those subcontractors agreements, you're also going to want to collect a certificate of insurance from all of those subcontractors and keep that on file. And a certificate of insurance, you'll hear that referred to as a COI. And basically what that is a document that lays out the coverages maintained by the sub, their limits of insurance, effective and expiration dates, and then it can also show you listed on as an additional insured on their policy. So at the end of the day, proper risk transfer controls in place, it's going to protect your liability. And most importantly, it's going to save you money. If your subcontractor is responsible for damage, they should be responsible to pay for that loss and defend you in the event of a claim. A poor performing subcontractor can upset the entire project. It can cause increased costs, increased risk of accidents, likely a poor work being performed, and cause you to miss deadlines. And all of these are going to affect your reputation and the bottom line in your margins on what you make on that deal. So you're starting a flip, you've got your subcontractor agreements, you've collected your COIs, you trust all your subs, so everything's all good. Why would you need to go out and purchase a full-blown general liability policy? Well, without a full-blown general liability policy, you're relying solely on those subcontractors' policies. In the event of a loss, especially with a construction defect claim that results from faulty work, it's not always easy to determine who was at fault. When you have your own proper GL coverage, you can turn that claim in to your carrier, get reimbursed for the damages, and then the insurance company can do the investigation and potentially subrogate against the subcontractors to recoup those expenses. So it puts that time and stress off of you. And lots of times I see certain package policies that people go with where they've got the property covered, they'll have renovations included on there, and then they'll have a small sublimit for general liability or personal liability, depending on the insurance form. And lots of times I see $100,000 or $300,000 limits in liability, similar to a homeowner's policy. So you see the coverage, it checks the box off for your lender, but majority of the time, those policies are not going to include the proper language that you need to respond in the event of a claim. So you've heard me say full-blown general liability coverage, proper general liability coverage. And what exactly does that mean? And it's basically general liability coverage that doesn't have any sneaky exclusions hidden in there that you're not aware of that would affect you or cause a claim to be denied in the event of a loss. And the two most common exclusions that I see included on a general liability policy, are the CG 2294 subcontractor exclusion and the completed operations, excluded all the way. There's no coverage for the completed ops. So the CG 2294 subcontractor exclusion, it does exactly what it's telling you what it'll do. And that's going to exclude all of the work completed by your subcontractors. So if you're subbing out 100% of the work, which is what we typically see on home flips, you essentially have no coverage. And if you went with that cheaper general liability option, you essentially paid for nothing because it's not going to respond anything related to the work performed by those subcontractors. In the completed operations section on the general liability, that's where that construction defect from faulty work claim would fall, because these are claims that come in after the work was completed, and they're typically don't arise until months, sometimes even years after that work was performed. And it's also important to note that these two exclusions, they could be included on your subcontractor's general liability policy, and you may not be aware of that. So with the CG 2294, it's a pretty hot, booming construction market right now. And a lot of times the subcontractor you hire is also subbing out to someone else to actually perform that work. And if that sub causes a problem, then your sub has the CG 2294 exclusion, those expenses are going to end up falling to you. With the proper full-blown GL coverage, your insurance is going to respond in those situations. And same with the completed operations coverage. If some of the common things that we see is subcontractors are constantly going in and out of business. It could be a few months later where that subcontractor is no longer around and you don't know who to call or who to go after because they've completely disappeared, or that they've missed a payment on their insurance policy and there's been a lapse in coverage. In both of those situations, you'd be able to rely on your own GL coverage if it was properly written to reimburse you for those damages. So this is just a claims example, and it's a pretty common situation that we see. So you've completed your flip, threw it on the market, you got all those multiple offers in same day. Hopefully we're talking 15, 20, 30,000 over asking. And after the homeowner moves in a couple weeks later, water starts leaking from the upstairs bathroom. It's going to it damages the walls, the baseboard, flooring, ceiling below. And what you think happened is that the bathroom cabinet installer dropped the cabinets on top of the sink, causing damage to the pipes underneath. But because this damage wasn't immediate until it became a huge issue when the pipe burst, you're not exactly sure who to go after. So you talk to the plumber. They say, hey, I did all the work perfectly. The pipes were fine when I installed them and I installed them correctly. Well, what about the cabinet guy? What are the chances that this cabinet guy says like, oh, hey, yeah, I accidentally dropped the cabinet on the sink, which probably caused that damage. So you're kind of in this situation of how do you prove who caused this damage? With the proper GL coverage, you're able to file that claim on your policy, get reimbursed for those damages, and then the insurance company is going to investigate that loss. Now, they may or may not find out the cause and who was at fault, but in the meantime, you were able to recoup those damages, and without the proper GL, you'd be looking at around, in this situation, this claim resulted in about $23,000. And another example, just within the last few weeks, it's a client I work with up in Minnesota, and they flip probably 5 or 6 homes per year, and they do all cash deals. So when I presented the general liability option, no, we trust our subs, that we get COIs. They had the risk transfer controls in place, and they were comfortable with their subs. And because it was cash deals, they didn't have any lender requirements. So they went with just a blanket builder's risk policy to cover all their projects. Well, when they called me, it turned out that they had a guy come in to do the spray foam insulation on that property. Turns out he used the wrong mixture, and all of that foam had to be removed and completely replaced. Well, what's the position that my client's in? The contractor they used is saying, hey, I'll make it right. But when you're in that position, do you trust them to go in and remediate that damage? Because they've already messed it up the first time. And then what's your other option? You have to go and hire an attorney. That's going to be expensive and timely to go after that contractor's policy. And you don't even know what kind of coverage that they're carrying. If they had purchased their own proper liability coverage, they would have been able to file that claim and let the insurance company do the investigation. And so they're looking at between $20,000 and $25,000 out of pocket in that scenario. So really, in summary, I think the biggest thing is working with an insurance advisor who understands flips, who understands your real estate investments. You may already have someone that you're working with, and I would say it's definitely worth later this week picking up the phone, shooting them an email, and asking them a few questions about some of the things we talked about today. You know, is there a vacancy provision in my property policy? Am I on a builder's risk form? Do I have theft and vandalism coverage? What about my general liability? Do I have a CG 2294 exclusion? Do I have completed ops coverage? It's really something that's what people like myself and other people that you probably work with are here to help you with. And just always use insured subcontractors, use those subcontractor agreements, collect those certificates of insurance. You could be looking at 2 different quotes from a plumber. One guy might not carry insurance and he's going to save you. His quote's much less expensive than the guy who's like, hey, I've got my insurance. I'll sign that subcontractor agreement. And it's just worth it. Again, going back to the total cost, to go with the person who's insured. And I'll say 90% of the time, when they have the proper insurance in place and they're willing to sign those agreements, you're going to get more quality work done from them, and it's going to decrease the chance of an issue coming up later. And like all of you are doing here this evening, just taking the time to understand some of these certain exposures. I know it's usually the last thing anyone wants to talk about. It's not fun, and no one's expecting you to become an expert on it, which is why you want to partner with a knowledgeable insurance advisor. But it really is worth your time to have a general understanding. And just like I mentioned, just sitting in on our presentation tonight. So just in closing, just a little bit more, Dave touched on a few of these things with his introduction, but I work Lowry Insurance. We're an independent agency. And when I say independent, we're not your Geico agent, your State Farm agent, where we represent one company. We have contracts with more companies than I could name. We do business, personal, benefits, so we can take care of the whole suite of the insurance that you need. But going back to the flips, we've got access to some exclusive builder's risk and GL programs. And at the end of the day, what I would like to do is what I enjoy doing is just to tailor coverage to meet your specific needs. everyone's situation is different in terms of the risk they want to take on and their unique projects that they're doing. And so I really do enjoy talking to people, whether you've done 100 flips or you're getting into your first project. I'm always happy to take time and talk to you to help you understand the certain exposures that you have. At the end of the day, your job is to make money on successful flips, and my job is to help you sleep. So, with that being said, we can open up to a few questions.
All right. Yeah, we do have a couple. And I guess we'll mention by trying to help us sleep, it's because we have the peace of mind and not because we're listening to your insurance presentation.
Yeah,
But,
but the presentation might work too, though.
okay. So, all right. Anyway, appreciate the questions and the input from our audience here. One of the questions deals with, and that was one I hadn't thought of either, about the time frame. So not as much as when coverage starts, but if I have not worked with you before, I understand the need. So let's say I'm about to close on a property, I'm going to flip. At what point do we contact, your office or any carrier about insurance? We've got to know we're getting the property and have all the specifics, but yet well, you see what I mean in terms of planning and what we need to be covered. And then is it the type of thing where, let's say, I do my first flip, when do I contact you? And then a couple months later, I'm ready to do another one. How does it work as far as setting up and, as far as considerations, things we need to be aware of and all that?
Yeah. So lots of times I get a phone call from someone who needs coverage yesterday. They're closing on a deal that afternoon or the next day. And I can't stress enough the importance of communication. While there are times that we can put a rush and push something through, the more time, the more lead and time that we have to market to our different companies, the better it's going to be for all parties. And so it can even be as soon as, hey, I'm putting in an offer on this property. Maybe that offer hasn't even been accepted, but we can still get enough information to have a quote teed up where when that offer is accepted, we've got everything ready to roll. And another important aspect of giving enough time is that the lenders are also going to need to see your proofs of insurance showing to meet their specific requirements and the mortgagee clauses. And oftentimes they're going to want to see a paid receipt. Getting all that information together in a day or two is sometimes really tough, or it could be absolutely impossible. So having at least, I'd say at a minimum, I'll need a week, but really as soon as you're looking at a deal, just pick up the phone, because we can run a quote and there might be some tweaks we need to make to that quote after the fact, but it's at least going to give you a baseline of, okay, this is what I'm looking at from the insurance side. And then when that deal is accepted, maybe the original plans on what you thought you were going to do with renovations, maybe those change and we need to increase some certain limits. All that can be done very quickly once we have the quote in place.
All right. Appreciate that, Neill. Another great question. And I know in your presentation, we were focused on flipping, but if anyone's involved with flipping or especially working with multifamily, the question came up that I guess it could even be a duplex or a two flat or something smaller. So what happens in the event of there's some type of damage or a claim, or I guess it's where would, let's say, renter's insurance or homeowner's insurance within a multifamily, but does that come in on something versus the need for the investor to have the coverage? How does that work?
I see what you're, and today we talked about flips, and I'm saying we've got exclusive markets for builder's risk and general liability in connection with that. But there's really not a whole lot that our agency can't do that's connected. There's a lot of different ways that people make money in real estate investments. And more likely than not, we're going to be able to find a good solution for you. So with this specific example, we'll just keep it simple, but it could range from a duplex up to, 7, 8, or a huge apartment complex. If you're the owner of that building, what you need to carry, and a lot of it comes down to, on the larger buildings, is going to come down to those association bylaws and what the tenants are responsible for. But we'll keep it simple with, like, say, a fourplex, where you've owned a property and you lease out all 4 units to different tenants. Well, in that lease agreement that you have with each of those tenants, it's really important to make sure that they're carrying their own renter's insurance. And so that's going to include their renter liability, and they can also include property coverage for all of their contents that they have in your space. But you're still going to need to carry the insurance on the building itself. And you're also going to want to have, from the liability side, it's known as lesser's risk, or simplify it down to landlord liability, where that's going to protect you if one of those tenants tries to say that you're not properly maintaining the property. And it could be as simple as not having a handrail on steps walking up to their unit, or they slipped, or you're not maintaining the property and they trip over something. So there's a number of things where you want to have the liability. And then their policies aren't going to cover the actual building. It's just a renter's policy, which will cover their liability. So if there's a no smoking policy and they were smoking in the unit, and that cigarette smolders overnight and causes the fire, at the end of the day, that's going to be on their liability, but you're not sure what their limits may be. And their insurance company could try to fight you or argue with you on that, which is why when you have your own property insurance as the owner of the building, they'll reimburse you for the claim, and then they can go and subrogate against the tenant's insurance policy.
All right, I'm going to jump in with a question that I thought of during that, and that would be using, let's say, the fourplex example. So suppose I live in I'm the owner of the fourplex, the investor, and I've got the coverage, but then I live in that fourplex. So this would be where would it be the point where my homeowner's insurance versus the business insurance owning the building. So that might be, I think, maybe if you can pick up on that a little bit, because there are situations where people are looking for something they can.
But in those situations, you would still want to have a commercial policy, because you're renting out as income from the 3 other units. And I'm not sure, I've run into this before, and I don't know if there's a personal lines carrier that is willing to even offer that type of coverage when it's an owner occupied building like that with other tenants. So you're still going to want to have your own commercial insurance policy, but as you being the owner and you're occupying it, you can also include some contents coverage on that for yourself and your own contents that you have in that space. But you don't want to go out and try to purchase just a regular homeowner's policy in those situations, because it really is set up as a business where you're generating income from those other tenants.
Well, that could be a whole nother webinar topic, because I'm sure, and I don't know that I can speak for everybody in the audience, but I'm sure there's people that hadn't thought of that if you live in, but you're renting out some, or, the rest of your property, the difference of having, or it sounds like not necessarily needing, your own quote unquote homeowner's policy, because you have the what I guess I'll use the term collective coverage within the business policy. And then that actually leads into the next question would be, or that I've got, it kind of leads into, would be for when the property is owned or the insurance policy is picked up by an LLC versus an individual, or just, all the corporation different settings. So are there any considerations that our investors need to be aware of? Because chances are some of the people viewing this, maybe they haven't yet decided, do I go LLC, do I go corporation, do I go partnership, or how might that work? So what considerations should they look for, and is there a difference in those scenarios?
So I wish I could give you a firm answer on that, but that's one of those that talking to an attorney is going to be able to give you the best advice in terms of protecting yourself. The most common thing that I do see is individuals setting up an LLC, which will help protect their personal assets. But in terms of really getting into any details, it's not something I'm not an attorney myself, and would definitely recommend consulting with your attorney to get their advice on the best way to set it up. Now, if you are just doing a project, your first project, and you're just doing it in your name, we can still set up these commercial policies in an individual's name. It doesn't have to be an entity to be written on a builder's risk or a commercial general liability form. It would be treated the same as a sole proprietorship. So it doesn't really matter in terms of setting up the policy, whether it's an LLC, a corporation, a partnership, or an individual name. But in terms of protecting yourself, that would be something to talk to an attorney about.
No, that's actually a great answer, Neill, because, and it's something we talk about a lot on our different events with REI USA members, is that it's not, oh, okay, I'll call my insurance guy and I won't have any legal problems. It's things like that. Now you've got to have, and that's why people wonder, why do I need a real estate attorney? There's exactly why. And so, just as an aside from your point, but an important one to the members, we talk about at REI USA, putting your team together, even
Right.
if you already had some investments. And there's a perfect example of why, because again, you as the investor may not catch something that an attorney would with regard to insurance. So that could be basically a major point.
Yeah, I mean, that's another thing that we tell a lot of our clients, and how we market ourselves is your CPAs, your attorneys, those are the first part of that team that you think of. And you really do also need to include your insurance advisors into that team and have them all work in connection with each other. It's really the best way to protect yourself from all sides.
Yeah, and I've got one more question, and that's an interesting one. We get some geographic considerations, and by that I mean, and the example used was, there are some areas, and it could even be within the same city or very close proximity, where, for example, flood insurance is not available, even though there's a flood threat. And that's just one example. And so the question is, for things like that, because it can vary, and somebody could own a property, two properties a mile apart, one can and one can't, even using flood insurance or the different specialty insurances. And so the question is, in terms of finding that out or looking into that, is that something that you handle? Or if I was an investor in that situation, do I have to know that? Do I have to have my attorney look into that? Or how is that, how do we deal with that?
Yeah, so a lot of the times, depending on that location, if you're located in the 100-year floodplain, that you're there, you can look that up. You can look up the flood zones online. And if you're located in one of those designated areas, I can guarantee you the lender is going to require you to purchase that flood insurance. Now, just because you aren't in a flood zone doesn't mean you have that exposure. And so I'm glad you brought this up, because one of the things I didn't mention on a builder's risk policy is, now it depends on the location, but if you're not in a floodplain, you can add very cheap flood coverage to a builder's risk policy. You can also add earthquake coverage. Now, these all depend on the location, But a standard property policy, you will never have flood coverage on there. And that's why the government has set up the flood program. So flood policies, while you can go through different insurance companies, they're all run by, now I'm blanking on it, but the National Flood Insurance, NFLIP, the National Flood Insurance Program. And those is what the government issues for your flood insurance. And just the geographic location of different properties. I mean, we work, like I said, we work with investors across the country. And why I always kind of say each specific scenario is different, because risk in right on the border of North Carolina, we have South Carolina, and the construction laws and defect claims, you have a 7-year tail in South Carolina for some of those claims to come in. And so it can vary state by state, and even more specifically in those states on certain guidelines, which is why it's always just important to make sure you understand, or that your agent understands the markets to get you the best coverage.
Right. And another great example for having that team in place
Right.
is there's other considerations. It's and I mean, just as examples and to finish up, because I want to stress the point to our members, REI USA, of because this also fits in with doing your research before you purchase a property, because there may be a floodplain obstacle or some type of a risk you would not typically think of, and that could make the difference between profit and loss. So we've got a couple of minutes left just to share another story that I came across from knowing and meeting with investors, was that they had a situation where a community expanded the housing development. The first one was to a certain point, and across the way was an open field, which, 10 years later, whatever it was, they started, another developer came along, started building on that field and builds a housing development. Well, and it's one of these horror stories, but these are the things we want to point out. So years later, the house across the street, like at the border of these developments, had a problem with their sewer line. And of course, they're responsible for the sewer line out to the point where it meets the city's connection. Well, because this was a new development, what this investor owner did not research was the sewer line didn't just go out to the sidewalk or the curb. It went across under the street to the other side of the street where the original development sewer line ended. So they had the expense of, it was either repairing or replacing the sewer line or whatever the problem was, not just out of their house, but all the way under the street, which meant digging up the street. And basically that was the difference between profit and loss on the property. And it was another, other investors saying that taught them to research things like that before making the purchase, because had they known, they would not have made the purchase. And so I'm telling the story not only from the insurance standpoint and what we're talking about, but it adds to the importance of doing your homework, thinking of everything. And it could possibly happen where, insurance coverage that you may need because of a situation, something may not be available, or it could even drive the cost of a premium up, or the insurance, or some additional things. And again, you're especially doing a flip, you're on a margin. And it's not only, it's the money as well as the time involved. And that was just another thing that you're dealing with permits from municipalities and other things that could delay. So the more information you've got going in from the investor point of view, then, the better off it could be. So just as another point, I didn't know if you had any, not that we want to do horror stories, but anything to add, on that. Maybe it's been something that you've had to deal with too, Neill.
I haven't seen a specific situation like that, but I mean, there's a handful of different scenarios that we just encounter where it just all goes back to, like you mentioned, having that trusted team and really understanding what's your risk and what's your exposure, in each situation. We've got, this kind of goes back to with the larger multi or the apartment complexes or like a homeowners association. But one of my clients here in Charlotte, it was that similar scenario where one of the unit owners, they left a cigarette on the porch and it caused a major fire. And one of the things that I had recommended in the previous year's meeting was on the rental policy was to make sure that you have sufficient coverage. It's an increased deductible, and it's something specific to a condo association when you own a unit, but that the master policy for all the buildings had a $25,000 deductible. Now, if you cause that loss, you could be responsible to pay that deductible. And there's a piece on your condo policy where you can increase the coverage, because typically they're only going to give you a couple $1,000s on that to pay for the difference, the deductible difference. And I had recommended everyone, hey, it's like 25, maybe $40 a year to increase that limit to match the master policy's deductible. And unfortunately, this unit owner did not do that, but our master policy paid out on the claim, but I can guarantee you they're subrogating against that owner's policy right now. And so she could be looking at a significant amount out of pocket. But there's countless examples of just not understanding what exactly is included in your policy and not asking you to be an expert, but that's what people like myself and other advisors that you're working with, that's what we're here for, to help you understand that.
Yeah, and that may be the best lesson out of this entire presentation, just our last few minutes and thinking of that. So, Neill McNair from Lowry Insurance, we really all appreciate the great information, the presentation. Neill's contact information is on there. You can also link to them through our partners page, sponsors directory on reiusa.com. So that will do it for this presentation. Again, we thank Neill with Lowry Insurance for the presentation, and we will let you go. We thank you very much on behalf of REI USA.
Thank you, Dave, and I appreciate everyone joining, and please don't hesitate to give me a call.
You got it. Bye-bye now.
Bye.